Michael Sansatera, one stock that you would rate a buy is Under Armour. Now, how are they doing in this epic battle against Nike?
You know, they're doing quite well, taking market share. Under Armour's done a great job of being not only very fashion forward, but also very useful. They've got new products like Coal Black. They've got a new shoe line called the Spine that's really taking some market share. And these guys are doing a good job of really appealing to not only the teens and the college students, but also some of the older, more mature users as well. So they've got the fashion forwardness, they've got the fitness trend pretty well marketed, and they're taking pricing. At the same time, they're spreading out their distribution, selling more direct to consumer through their website, and selling the number of shares, the number of stores rather, that they're actually available in keeps growing. Company's been growing north of 20%, both revenue and earnings. We think they can keep taking share from Nike right now. And it's all domestic, so you get to avoid some of the European exposure and the European fear. 90% of this company is sold in the United States.
Another stock that you're bullish on is Chipotle. How much can they grow?
Chipotle can be double its size with little trouble because they sit in the mid spot of that not fast food, not high end, sort of that fast middle ground. They can take some market share from both sides. So they can take from the Taco Bells of the world as well as all the mom and pop restaurants, the Mexican restaurants that you know and love and grew up around. They're priced in the middle. They've got a little over 1,500 stores. We think it could be easily double that. The comps or the same store sales had high expectations in the previous quarter, and they didn't quite hit that number, but at the same time they managed their revenue and earnings quite well, which tells us they're managing their business even when they don't have that massive secular trend behind them. They're managing quite tightly, and that's the kind of company that when you get a pullback like we think we've seen in the shares, you can buy the stock now for the longer term.
And speaking of taking share, another stock you like is Arm Holdings. They've done very well with their mobile chips, but they're trying to take share away from Intel and PCs and servers. Do you think they can win that battle?
You know, we think it's going to be a good battle, and they'll be able to take some market share there as well. You know, the sweet spot for ARM has been they've been able to produce semiconductors and IP based around those semiconductors that use less power and therefore less battery life. So in mobile, that's been a real powerful story, right? Lots of cell phones and lots of tablets. Intel's really wanted to be more dominant in this space, and they've not been able to gain traction. Now ARM's taking the fight really to the netbook, to the notebook. You'll see it on the server side, at the x86 side. You'll see ARM chips running Windows. That'll be the first semiconductor to not be Intel-based, or I should say x86 based because AMD runs them as well, but to really run a Windows platform. So ARM will bring all the competitiveness they brought from the mobile and the tablet side to the Windows side, to the server side, maybe even to the switching side as we get a little further down the road. We think they can be competitive. We think the pricing will be right. We'll think a lot of OEMs will definitely try them as a solution.
Okay, those are three stocks that you like. Is there a stock or sector that you would sell right here?
Yeah, at Sylvan Capital Management and in the Ridgeworth Large Cap Growth Fund, we're looking for companies that can exceed investor expectations and have key metrics that are really growing. We're a growth manager. We don't see a lot of growth in utilities right now, so we would be not interested in buying those stocks. At the same time, we don't see a lot of growth in the materials section as well. These companies are typically far more cyclical. They're not in the good spots of their cyclicality, such that the cyclical growth is really coming back. So at Sylvan and Ridgeworth, we're just not interested in those types of companies right now.
This market has fewer players.
We're coming into a Monday where we're going
to enter a new stage at tech.
It's a stock picker's market.
Welcome to the 5 dumbest things.
Apple reported earnings.